All right, let's do something a little different today. We're going to jump in a time machine and go all the way back to 1984. Why? Because we're going to unpack a masterclass in investing straight from one of Warren Buffett's shareholder letters. And let me tell you, the principles we're about to cover are just as powerful, if not more so, for any serious investor operating today. So, back in 1984, Berkshire Hathaway's net worth grew by 13.6%. Now, for any professional portfolio manager, you'd be pretty happy with that, right? A double-digit gain, that's a solid year. You'd definitely be happy to report that number. But here's the kicker. The man who actually delivered that number, Warren Buffett himself, called it mediocre. Yeah, mediocre. That one single word, it just forces you to stop and rethink everything about how we measure success in this business of allocating capital. So that's the big question, isn't it? If 13.6% is just mediocre, what in the world is the real scorecard? Well, this letter gives us the answer. It's so much more than a history lesson. It's a foundational mindset. We're going to break down 4 timeless lessons that really define a superior framework for any capital allocator out there. Okay, first up, and this is maybe Buffett's most fundamental lesson. You have to learn to look past the deceptively clean, precise numbers you see on an income statement. You have to focus on what's truly driving the long-term value of a business. So here's the core idea. Buffett says that while you can't calculate intrinsic value with the same false precision as accounting earnings, it is the only economic yardstick that actually matters. Your job as an investor is to truly understand the underlying economic engine of the business you own a piece of. And this idea comes to life perfectly in this little disagreement Buffett had with his auditors. See, the accountants, they saw a sale of stock, which meant booking a capital gain, but Buffett pushed back. He argued that because his actual ownership stake in the companies didn't change one bit, the cash he got was, for all intents and purposes, a dividend. The accounting label was totally irrelevant. The economic reality, the cash in his hand and the ownership stake, was what mattered. And this right here is such a powerful tool for any analyst. You have to learn to separate the economic substance from the accounting form. Honestly, mastering this distinction is probably the very first step toward building a real, meaningful scorecard for your investments. Now, this focus on substance over form leads us right into lesson number 2, how to actually judge the people running the businesses you invest in. And Buffett gives us this incredibly powerful litmus test for figuring out if management is really on the side of shareholders. In that test, it all centers on a company's approach to share repurchases. Now, for Buffett, this isn't just some simple financial maneuver. No, it's a crystal clear window into the true motivations of the management team. Think about it. Management faces this critical choice. They can buy back their own stock when it's trading for less than it's worth. A move that Buffett points out is like getting $2 of value for every $1 you spent. Or they can go chase these big empire-building acquisitions that, let's be honest, very often destroy value. Their decision tells you everything you need to know about whether their priority is building shareholder wealth or just building a bigger corporate kingdom. You gotta love how sharp Buffett's language is here. He's basically warning us, don't listen to the eloquent speeches about maximizing shareholder value. You have to follow the capital. As he puts it so brilliantly, a manager's heart may not be listening to his mouth. So this gives us a practical, observable way to judge them. Forget the platitudes you hear on the earnings call. Go read the 10K. The cash flow statement will show you exactly where the capital is really going. That's how you figure out if management is actually working for you. The third lesson takes this whole framework and expands it, showing how this business owner mindset can apply to absolutely every asset class. Yup, even something as seemingly straightforward as bonds. This is just a brilliant reframing of an investment. When Berkshire bought these distressed WPSS bonds, Buffett didn't see a debt instrument with a coupon. No, he analyzed it as if he were buying a whole business. And just look at the results. For $139 million, he bought a business that was generating $22.7 million in after-tax earnings. To get that same earnings stream by buying an actual company would have cost him 2, maybe even 3 times more. It's an incredible insight. And of course, this brings us right back to that foundational wisdom from his mentor, Benjamin Graham. It's such a simple idea, but it's so profound. It just cuts through all the noise of day-to-day market swings. When you adopt this perspective, it becomes this universal tool for analysis. It absolutely forces you to ask the right questions about price, about value, and about long-term returns, no matter what asset you happen to be looking at.
Okay, our final lesson. This one tackles one of the most critical decisions a CEO ever has to make. What do you do with the profits? Do you pay them out to the owners, or do you reinvest them back into the business?
Buffett starts by making a really important distinction. He focuses on what he calls unrestricted earnings. This is the true distributable cash profit, after you've already spent what's needed just to maintain the business and stand still. We're talking about the real excess cash here. And from there, he lays out this beautifully simple but incredibly rigorous test. A company only earns the right to keep your capital if it can pass this two-step hurdle. For every single dollar it keeps, can it reliably create at least $1 of market value for you, the owner? And that only happens one way: if the company's internal opportunities for reinvestment can generate returns that are better than what you, the investor, could achieve elsewhere. If they can't do that, then management has a fiduciary duty to return that capital to you. It's just a clear, rational standard that every single business ought to meet. And so, this incredible masterclass from 1984 leaves us with a really direct and powerful challenge. I want you to apply this to your own portfolio. For every company in there that's retaining its earnings, ask yourself, is it really creating more than $1 of market value for every dollar it keeps? It's a simple question, but answering it honestly, well, that's the mark of a truly business-like investor.